Now I'm going to take you through conditional orders that are also called stop orders or trigger orders. The first thing to be aware of is that the order is not live until it's triggered. So you'll need to have available cash or available shares at the point of trigger for that trade to go to the market. If, for example, you've already put your Wesfarmers shares for sale into the market, those shares are now not available to sell again for a trigger because it won't cancel that order. So you find the stop orders in the normal place, and all Marketech Focus subscribers have access to them. When you first go to place your first stop order, have a read through all of the explanations, and if you still don't understand, come back and watch the video again. So when the ticket opens up, you'll notice that there are two parts to it now. One is the trigger, and secondly is the order. So the first thing that you need to do is choose where you want that trigger to occur. So if, for example, I wanted to put in a stop loss, I might put my trigger at, say, 55.83, and then choose to sell those shares down to, say, 54.69, and then place the order. So now what we've got is a trigger and an order. The reason that I've placed the order lower than the trigger is that if I put it in at 55.83 and the stock was in free fall, you might find that you actually get stuck in the queue behind a number of people hoping that you've been triggered. So normally we would recommend that you place it a little bit lower in the event of a stop loss. Now, if you wanted to have a take profits target above the current share price, as well as maintain a stop loss below the current share price, you can't just put it for sale in the market, because then the stop loss, if triggered, won't have stock available to sell. So what you would do is put in another sell above the market at a higher price in the same manner. Now, sometimes people want to buy what's called a breakout. So in the event that a stock has run to a certain point, you might find that you don't want to buy it at today's price. You want to wait until it's hit that breakout point before it gets above. So it's a good example of where you could use a buy stop. You would set your trigger at the price at which the breakout's about to occur, and then you would buy up to a slightly higher price to chase that break. Now, another thing that you can use stop losses for is to take profits or to buy at a significantly lower or higher price than what the current market is. Because of the ASX rules, you can't allow you to place trades at a significant premium or discount to the market. Normally they expect that you'll be able to place those trades around the market price. And it's different for the different companies, the different sizes and the different volumes that they do. So if your order is rejected because it's too far from market, what you can do is use a trigger at a higher price to then set the trade once it gets closer to that higher price, and the same if you wanted to buy it at a lower price that's significantly further away from the market than you're allowed. As it gets closer to that level, you should be able to set a trigger with the opportunity of then buying. So if you're looking at trying to trade 50% away from the market, you're expecting a big drop or a big rally, then you can use stop orders for that manner. We'd also recommend that you integrate in use of things like alerts to try and give you the heads up before it gets to that price, because as I said, conditionals can sometimes be quite tricky.